Hi, Bill Lethman here for MoneyEvolution.com. Welcome back to our video series all about annuities. So if you watched the first video, we had a high-level overview about annuities, kind of an introduction. We talked about 5 of the common reasons that some people might look towards buying an annuity for their retirement. We talked about some questions that you should ask before buying an annuity and some things to watch out for. And we also talked about where an annuity might fit into your overall retirement planning strategy. So now we're going to start taking a deeper dive. We're going to be talking about the 4 basic types of annuities, and in this video we're going to be talking about the single premium immediate annuity and the deferred income annuity. So the best way we can kind of describe this type of annuity is to think of it a little bit like a pension plan. So if you understand how a pension works, you know that the company typically puts money into an account on behalf of the employees over the course of their career. And then when they retire, they pay that money back in the form of usually a monthly check to that individual that's usually guaranteed for the rest of their lifetime. If you're married, you can oftentimes include your spouse in that as well, so that even if you pass away early, your spouse is going to continue either getting that full check or some portion of that check, depending on what your elections are. So a single premium immediate annuity kind of works the same way. But unlike a pension, you're actually contributing the money yourself. So in this case, you're going to be depositing money to an insurance company, and in return, they're going to give you a regular stream of income. So to kind of illustrate this, let's use kind of an example here. Let's say you're 65 years old, and let's say you've done some financial planning, and through that financial planning process, you've discovered that you have a gap, and you would like an additional $30,000 a year coming in on a regular basis to kind of meet some of those cash flow needs. So looking at some of the options, with a single premium immediate annuity, you've discovered that you can invest about $504,000 with an insurance company, and in return, they're going to give you that $30,000 a year for the rest of your life. We also, because you're married, let's say, we're also going to ensure that should something happen to you, that same $30,000 check is going to come in for your spouse as well. So as you're considering this, there's a few things to think about. Number one is, as you deposit the money with a single premium immediate annuity, you have a couple of choices. One choice we just talked about here, which was the joint option. And I think for most of you that are married, I think that that's an option that you absolutely should consider. But there's a couple of other options in there as well. One is a certain period. And so what that means is that regardless of how long you live or you and your spouse live, that insurance company is going to continue making those payments for a minimum period of time. An example of that would be a 10-year period. We talked about joint as another option. And another option that you could select as well is a return of premium. And what that means is that regardless of how long you live, the insurance company is going to at least pay you back out, or pay your heirs back out, I should say, at least as much as you put in. So in this case, if you both passed away early, your kids are going to still be guaranteed to get at least that $504,000. So as you might expect, each one of these options that you select is going to potentially make that income that you're getting from the insurance company go down a little bit. So one of the things, if you go back and think about it in terms of the pension example, one of the reasons they can guarantee your payment as long as you live, even if you live to be, let's say, 100 years old or older, is because not everybody's going to live that long. And there's something within these annuities called mortality credits. And what that means is that they're going to give you a higher payout than what you might be able to earn, let's say, on your own, because they're balancing out the fact that some people are going to live longer with the fact that some people are going to live a lot shorter. So those people that die early actually help to pay for the people that live longer. Okay, so that's a single premium immediate annuity. Now let's talk about a deferred income annuity, and let's take a look at how that looks. So let's kind of back the clock up here 5 years, and now let's say you're 60 years old and you're planning on working a few more years, and you want that $30,000 a year income stream to start at age 65. So now, looking at a deferred income annuity, we learned that you can invest about $422,000 with the insurance company, and deferring for 5 years is going to equal that same $30,000 a year income stream that you would have gotten at age 65. So that's all that's basically going on there with that, is deferred income annuity is delaying the payment, and you're actually building up a little bit of that income stream for a few years. Now we can actually kind of put some math to this a little bit here, and we can say, okay, well, if I know I have to invest $504,000 at age 65 to get a $30,000 a year income, but I only have to invest $422,000 a year if I do it 5 years sooner, then we can actually do some math using a financial calculator, and we basically learned that about 3.57% is essentially the guaranteed rate of return that we're earning on that money. In other words, that 422 is growing to the amount of $504,000 over that 5 years. The other way we can start to calculate some numbers here too, and if we look at the math over here, one of the variables we don't know. We don't know how long you're going to live or how long you and your spouse are going to live if we're doing a joint income. But we can still use a financial calculator. We can put in how much would a $504,000 investment returning $30,000 a year for a set number of years, and we can start to calculate that a little bit if I live to be age 80 or if I live to be age 85 or 90, and we can start to get some sense of that. One of the big things that we want to talk about here, though, as we look at the single premium immediate annuities and the deferred income annuities, is that you're giving up all control of the money. Basically, all this money is going to the insurance company. It's in their hands now, and you don't get to change your mind. You don't get to do anything with it over that period of time. You've essentially locked that money up. And so for that reason, these tend not to be very popular options because a lot can happen, especially if we're talking about somebody that's 60 or 65 years old and hopefully is going to live to be up into their 80s or even their 90s. And there's no ability to go back and change that. An exception to this, though, is that if you've elected the return of premium before the start date feature on a deferred income annuity. So in other words, if you've deposited your money with the insurance company and sometime in that deferral period, in this example here, sometime between age 60 and 65, you elect to change your mind and say, hey, I don't want that anymore, or find something better, you can take your original premium back out. You're not going to get any interest or any credits back to you, but there is that option in certain circumstances where you can get your money back there. That's called the return of premium before start date feature, and it may come at a cost depending on the annuity that you're selecting. So anyway, I hope this has been informational for you, whether or not you're considering a single premium immediate annuity or a deferred income annuity. At least you have a better understanding either to say, hey, that's right for me or that's not right for me. Like I said before, because of the loss of control that you generally have with this type of annuity, they tend not to be very popular. It is, however, going to give you generally the largest check out of any of the annuity options if you're just focusing on the income part of that. It's generally going to be the best option, and again, very similar to what you might have with a pension plan as well. So anyway, that's the first video. In the next video, we're going to be talking about fixed annuities, and we'll get into some details about that. And then yet to come are fixed indexed annuities and then variable annuities, and then we've got a couple of bonus ones we're going to add in there as well. So check out that description below and some of the links and that to the other videos and the playlist within this series. And if you like what we're doing here, don't forget to hit that like or subscribe button, and I'll see you back in the next video. Thanks.